Imagine waking up one day to discover you have bank accounts you never opened, credit cards you never applied for, all in your name. This wasn't a nightmare for thousands, it was a devastating reality brought to light by the Wells Fargo fake accounts scandal. It exposed a systemic problem where employees, under immense pressure, created millions of unauthorized accounts. But beyond the headlines, this crisis revealed critical mistakes many people make, unknowingly leaving themselves vulnerable. Today, we're diving deep into these common pitfalls, so you can safeguard your financial future and avoid becoming another statistic. Let's uncover the surprising truths. First, let's quickly recap what happened with Wells Fargo. In 2016, it became public that Wells Fargo employees had secretly created millions of deposit and credit card accounts for customers without their knowledge or consent. This was driven by aggressive sales quotas, pushing employees to meet unrealistic targets. The scandal cost the bank billions in fines and severely damaged its reputation. But for the average person, the question isn't just, how could this happen? It's, what did I miss, and how do I prevent it from happening to me? This scandal serves as a harsh lesson in financial vigilance. The absolute biggest mistake people make, and one that directly allowed the Wells Fargo scandal to fester, is simply not reviewing their bank statements carefully. Many of us glance at the balance, assume everything is fine, and move on. But these statements are your primary defense. They list every transaction, every account. If an unauthorized account was opened, you might see small, unusual fees, or even an unfamiliar account number. Ignoring these details is like leaving your front door unlocked. You're inviting trouble without even realizing it. Think of it this way: Sarah, a busy professional, received her monthly Wells Fargo statement. She usually just checked the final balance. But one month, a small, recurring service fee of just $5 caught her eye, for an account she didn't recognize. Instead of dismissing it, she investigated. It turned out to be a checking account opened in her name, without her consent, purely to hit an employee's quota. This small discrepancy, if ignored, would have continued draining funds and potentially impacted her credit score without her ever knowing. That small fee was the red flag. Another major mistake is placing blind trust in financial institutions. While banks generally operate with integrity, the Wells Fargo scandal showed us that even trusted names can have internal pressures leading to misconduct. It's easy to think, it's a big bank, they must be doing things correctly. But this complacency is dangerous. You are ultimately responsible for your own financial well-being. A healthy dose of skepticism isn't paranoia, it's smart personal finance. Always verify, never assume. Your money, your responsibility. The illusion of security is powerful. We deposit our money, assuming it's safe and that the bank will always act in our best interest. This is largely true for many transactions, but when incentives align poorly, as they did with Wells Fargo's aggressive sales quotas, the system can break down. Customers, lulled by years of smooth banking, didn't question basic processes. They signed forms without reading, or simply took the bank's word for it. This isn't about distrusting every single employee, but about understanding that institutional pressures can sometimes override individual ethics, making vigilance your best friend. Many people simply don't know their rights as consumers, especially concerning financial products. If a bank opens an account in your name without your consent, that's not just a mistake, it's a violation. You have the right to challenge unauthorized transactions, dispute fraudulent accounts, and expect clear communication from your bank. Without understanding these fundamental rights, you're at a significant disadvantage when trying to resolve issues. Education is empowerment. Knowing what you're entitled to means you can demand it, rather than just hoping for a resolution. Consider Mark, who discovered a mysterious credit card on his Wells Fargo statement. Instead of just canceling it, he immediately knew he had rights. He cited federal consumer protection laws and demanded a full investigation, not just a simple closure. He knew the bank was obligated to provide evidence of his consent. This knowledge empowered him to push back effectively, ensuring the unauthorized account was removed from his record, all associated fees were waived, and his credit score remained untarnished. Without knowing his rights, he might have struggled, accepting a less favorable outcome. Another critical mistake is dismissing small, seemingly insignificant discrepancies. People often think, it's only a few dollars, or it must be a mistake, I'll deal with it later. But in the Wells Fargo scandal, these tiny errors were often the only clues that something was deeply wrong. A $3 monthly maintenance fee on an account you don't recognize, a small transfer you didn't initiate, or even a change in your online banking dashboard. These are not minor inconveniences, they are potential alarms. Always investigate, no matter how small the amount. Fraud often starts subtly. Let's consider Emily, who noticed a new savings account tab suddenly appear in her online Wells Fargo portal, despite never opening one. It had a zero balance, so she almost ignored it. But her instinct told her to click. She found it was indeed an unauthorized account, open to help an employee hit their target. If she hadn't investigated that zero balance account, it might have accumulated fees, or been used for other fraudulent activities later. Her proactive scrutiny, even of something that seemed harmless, prevented a potential headache and protected her financial integrity. When you find an issue, a huge mistake is not documenting every single interaction. This includes dates, times, names of representatives you speak with, what was discussed, and any reference numbers provided. If you call the bank, note it down. If you send an email, save it. Take screenshots of online interactions. This paper trail, or digital trail, is your invaluable evidence if the issue escalates or isn't resolved properly. Without documentation, it becomes your word against theirs, and that's a battle you're less likely to win. Think of what happened to David. He called Wells Fargo about an unauthorized account, and a representative assured him it would be closed. He didn't write down the details. Weeks later, the account was still open, and he had to start the process all over again, with no proof of his previous call. If he had documented the initial conversation, including the representative's name and a case number, he could have escalated the issue much more quickly and effectively, pointing to the bank's failure to follow through on its promise. Documentation is your strongest ally. When facing resistance or unsatisfactory answers from initial customer service, a common mistake is giving up or not knowing how to escalate the issue. Don't stop at the first phone call. Banks usually have multiple tiers of customer support, a dedicated fraud department, and even executive complaint lines. If internal channels fail, external regulatory bodies like the Consumer Financial Protection Bureau, or the Office of the Comptroller of the Currency, are there to help. Knowing this chain of command is crucial for effective problem solving. The Consumer Financial Protection Bureau, or CFPB, is a government agency specifically designed to protect consumers in the financial marketplace. They can investigate complaints against banks and other financial institutions. If you've exhausted your options with the bank directly and still haven't found a resolution, filing a complaint with the CFPB is a powerful next step. They don't just log complaints, they actively work to mediate and enforce regulations. This is a resource many people overlook, but it's one of your strongest tools against institutional wrongdoing. Perhaps the most pervasive mistake is the belief that it won't happen to me. We often hear about scandals and think they're isolated incidents affecting only a few unlucky individuals. The Wells Fargo scandal proved that systemic issues can affect millions. No one is immune from potential fraud or misconduct, regardless of how careful they are. This mindset leads to complacency, which is exactly what fraudsters and negligent institutions rely on. Adopt a proactive, vigilant approach to your finances. It's not about paranoia, but prudence. The Wells Fargo fake accounts scandal didn't just affect a few hundred customers. Initial estimates pointed to over 2 million unauthorized accounts. That's a staggering number, representing individuals from all walks of life, across the country. This widespread impact highlights that financial misconduct isn't discriminatory. It can target anyone. Understanding the sheer scale of such issues is crucial to shifting from a reactive mindset, "Oh no, it happened to me," to a proactive one, "How do I ensure it doesn't happen to me, and what do I do if it does?" Unauthorized accounts can also negatively impact your credit report and score. A mistake people often make is neglecting to regularly check their credit reports. Fake accounts, even those with zero balances, can appear as new lines of credit, potentially lowering your credit score or making you appear riskier to lenders. Moreover, if fees accrued on these accounts and went unpaid, they could turn into delinquencies. You're entitled to a free credit report from each of the 3 major bureaus annually. This is a vital check for identifying unknown financial activity. Your credit report is a detailed history of your borrowing and repayment habits. It includes information like accounts opened, credit limits, payment history, and inquiries. When you review it, look for any accounts you don't recognize, credit inquiries you didn't authorize, or changes in your personal information. These could all be signs of identity theft or fraudulent accounts. Websites like annualcreditreport.com allow you to access your free reports from Experian, TransUnion, and Equifax. Make it a yearly habit, like a financial checkup. Putting all your financial eggs in one basket, meaning having all your accounts, checking, savings, loans, investments, with a single institution, is another common mistake. While convenient, it amplifies your risk if that institution experiences a breach or internal misconduct, as Wells Fargo did. Diversifying your banking relationships spreads your risk. For example, keeping your primary checking account with one bank, savings with another, and perhaps a credit card with a third. This way, if one institution falters, your entire financial life isn't compromised. Diversification isn't just for investments, it's a smart strategy for your banking, too. If an issue arises with one bank, like unauthorized accounts, your funds in other institutions remain secure and accessible. This approach can also provide you with access to different services, better interest rates, or more competitive fees from various providers. It's about building a resilient financial ecosystem for yourself. Don't let convenience override the critical need for security and redundancy in your financial planning. Finally, a mistake that underpins many fraud scenarios: not rigorously protecting your personal and financial information. While the Wells Fargo scandal involved internal fraud, it highlights the broader need for vigilance. Your social security number, date of birth, address, and account numbers are valuable to fraudsters. Be wary of phishing emails, questionable phone calls, and insecure websites. Use strong, unique passwords for all your online banking. The more careful you are with your data, the harder it is for anyone, internal or external, to compromise your accounts. Think of your passwords as the keys to your financial kingdom. Using weak passwords or reusing them across multiple sites is like using the same flimsy lock on every door. Utilize a password manager to create and store complex, unique passwords. Enable two-factor authentication wherever possible. It adds an extra layer of security. Practice good data hygiene, shred documents containing personal info, avoid public Wi-Fi for banking, and be mindful of what you share online. These habits significantly reduce your vulnerability to all forms of financial fraud. Now, let's debunk some common myths. Myth number 1: my bank will always catch fraud on my behalf. While banks do invest heavily in fraud detection, they are not infallible. The Wells Fargo scandal itself is proof of this. Internal fraud went undetected for years until whistleblowers came forward. Automated systems can miss subtle patterns, and human oversight can fail. You cannot rely solely on your bank to be your only line of defense. They are partners, but ultimately, you are the primary guardian of your own accounts. Your proactive checks are indispensable. Myth number 2: only large, obvious transactions matter, small ones are harmless. As we discussed earlier with Sarah's $5 fee, this is absolutely false. Fraudsters and unauthorized activity often start small precisely because they are less likely to be noticed. Banks might even deliberately keep initial fraudulent charges low to test the waters. Don't fall into this trap. A small, unrecognized charge can be the canary in the coal mine, signaling a much larger issue brewing beneath the surface. Treat every unfamiliar transaction with suspicion. Myth number 3: if I just close the fraudulent account, everything is resolved. While closing an unauthorized account is a crucial step, it's not the end of the road. You need to ensure the account is officially removed from your records, all associated fees are waived, and any negative impact on your credit report is corrected. Furthermore, you should ask for a letter from the bank confirming the fraud enclosure. Simply closing it without these follow-up steps could leave lingering issues that come back to haunt you later. Myth number 4, my old, established accounts are safe from this type of fraud. This is another dangerous assumption. While new accounts might seem like the primary target for unauthorized openings, existing accounts can also be compromised. Your personal information, once in the system, could be misused by internal bad actors, or become part of data breaches. Regular monitoring of all your accounts, old and new, is essential. An old, dormant savings account could suddenly show activity if compromised. Stay vigilant across your entire financial portfolio. So, how do we protect ourselves? Our first actionable step is to make reviewing your bank and credit card statements a non-negotiable habit. Don't just glance at the balance. Scrutinize every transaction, every fee, every account listed. Set aside dedicated time each month. Opt for digital statements and alerts so you can catch discrepancies quickly. If something looks off, even slightly, investigate immediately. Remember, early detection is your strongest defense against financial fraud and misconduct. Next, actively monitor your credit reports. You can get a free report from each of the 3 major credit bureaus once a year at annualcreditreport.com. Stagger these requests, for example, get one from Experian in January, TransUnion in May, and Equifax in September. This way, you're reviewing your credit profile every few months, providing continuous oversight for potential unauthorized accounts or suspicious inquiries. Consider free credit monitoring services offered by many banks or credit card companies for real-time alerts. Third, practice robust information security. Use strong, unique passwords for all financial accounts, ideally generated and stored by a password manager. Enable two-factor authentication whenever available, it adds a crucial extra layer of defense. Be extremely cautious of phishing attempts via email or phone. Banks will rarely ask for sensitive information through these channels. Shred financial documents before discarding them, and be mindful of what personal information you share online or on social media. Your data is your digital gold. Fourth, consider diversifying your banking relationships. While convenient to have everything under one roof, spreading your accounts across different institutions mitigates risk. If one bank faces a scandal or data breach, your entire financial life won't be exposed. This doesn't mean opening dozens of accounts, but perhaps having your checking with one reputable bank, savings with another, and investments with a third. It creates redundancy and ensures that you always have accessible funds, even if one institution is temporarily compromised. Fifth, empower yourself by knowing your consumer rights. Understand what constitutes fraud, what banks are obligated to do, and who to contact if things go wrong. Document every interaction thoroughly, from phone calls to emails, with names, dates, and reference numbers. If initial customer service fails, don't hesitate to escalate the issue to higher-ups or even external regulatory bodies like the Consumer Financial Protection Bureau. Being an informed and persistent advocate for yourself is often the key to resolving complex financial disputes. If you suspect you've been a victim of unauthorized accounts or fraud, here's what to do immediately. First, contact your bank's fraud department. Explain the situation clearly and provide all your documentation. Second, freeze your credit with all 3 major bureaus to prevent further unauthorized accounts from being opened. Third, file a report with the Consumer Financial Protection Bureau, CFPB, and potentially your local police department. Lastly, frequently monitor your credit reports and financial statements for any new suspicious activity. Swift action is paramount. The Wells Fargo fake accounts scandal left a significant legacy, not just for the bank but for consumer trust. It reinforced the painful lesson that even reputable institutions can prioritize profits over ethics, sometimes at the direct expense of their customers. For us, the enduring lesson is the absolute necessity of financial vigilance. It's not just about guarding against external hackers, but also understanding the internal dynamics of the financial system. We need to be active participants in protecting our financial health, not passive observers. The scandal also spurred changes within the banking industry and regulatory frameworks. Banks are now under increased scrutiny regarding sales practices, and consumer protection agencies have gained more teeth. However, these changes don't absolve us of our responsibility. The financial world is constantly evolving, with new products and digital platforms emerging. Staying informed, adaptable, and proactive in managing your money isn't just a reaction to past scandals, it's a fundamental requirement for navigating the complexities of modern personal finance successfully. Ultimately, your financial security rests largely in your hands. While banks have a duty of care, the Wells Fargo scandal painfully illustrated what can happen when that duty falters. By understanding the common mistakes people make, like ignoring statements, trusting blindly, or not knowing their rights, you can empower yourself to become a vigilant consumer. This isn't just about protecting your money, it's about asserting your rights, maintaining your peace of mind, and ensuring that your financial journey is one you control, not one dictated by hidden accounts or corporate misconduct. Let's quickly recap the biggest mistakes people make when it comes to scandals like Wells Fargo's. 1. Not reviewing bank statements meticulously. 2. Blindly trusting financial institutions. 3. Not knowing your consumer rights. 4. Ignoring small discrepancies. 5. Failing to document interactions. 6. Not escalating issues properly. 7. Believing it won't happen to me. 8. Neglecting credit report monitoring. 9. Over-relying on a single institution. 10. Not protecting personal information. By avoiding these pitfalls, you empower yourself immensely. The Wells Fargo fake accounts scandal was a painful wake-up call for millions, highlighting the essential need for every individual to be an active, informed participant in their own financial life. Don't wait for another scandal to learn these lessons the hard way. Take action today, review your statements, check your credit, secure your data, and know your rights. If you found this information helpful, please like this video, share it with someone who needs to hear it, and subscribe for more insights into safeguarding your finances. Stay safe, stay vigilant, and stay informed.